Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list. Questions floated to me from across the interwebs, in the comments section, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. And now for this week's question. So this week's question is, how long do I have to pay premiums on my whole life policy? The short answer to that is basically for as long as you want. The long answer is that you have a lot of choice as to how long you pay premiums, with a caveat, kind of there's some nuance in there. Basically, most whole life policies, virtually all whole life policies, have a guaranteed level premium that must be paid. You either have to pay it out of pocket or with policy values, but it has to be paid. And most whole life policies are like a pay to age 100 or pay to age 98 or 99. But these can be modified to a 10 pay, 20 pay, 12 pay, 7 pay. There's different payment periods you could make the policy where you pay for X number of years, and then the policy is essentially paid in full. You don't have to make any more premiums. And so you can design it from the very start to pay so that you pay as much premium as you want to pay. And even if you change your mind later, virtually all whole life policies have what's called a reduced paid up option, where you can take your existing death benefit and reduce it and make it a paid in full policy. And the way that works is the insurance company will look at the current cash surrender value, and they'll determine how much death benefit that cash value will buy for the rest of your life. And then they will lower the death benefit to that amount, and then no more premiums are due. And that's it. So there's a way to shorten your premium paying period if you change your mind after the fact. And every policy that I design for policyholders, for my clients, allows the policyholder to pay premiums for just a few years, all the way out to the insured's age 100. There are some exceptions to this, but for the most part, that's how it's done. Usually the exceptions are due to underwriting limits, but generally premiums are very, very flexible. The flexibility comes largely from the way the policy is designed. If an agent is going to sell what's called an all-base whole life, you have kind of limited options. You still have options, but they're kind of limited. The policies that I design for clients have a minimum base premium that has to be paid, just like every other policy. It's a guaranteed level premium, has to be paid every year, and then sort of this upper optional premium that's sort of a minimum premium and then a maximum annual premium. And the difference between the base premium and that upper limit maximum annual premium is filled in with sometimes a combination of like a term and paid up additions rider, or sometimes it's just a paid up additions rider. And so but that's an optional premium that you get to pay extra premium. You have the option to pay it, but you don't have the requirement or obligation to pay it. So if you do pay that optional additional premium, it greatly enhances the cash value and death benefit growth in the policy. The base component of the policy is required by the insurance company. I can't overstate this. It has to be paid either out of pocket or with policy values, meaning premium loans or accumulated dividends and current dividends. In some way, it has to be paid. This base whole life policy establishes the contract as the life insurance policy and is the basis for all the guarantees in the policy. So that part has to be paid. For the most part, policies are also designed, the ones that I do anyway, are designed as a term blended policy with paid up additions. And the way that works is generally there's an initial amount of term insurance that's purchased, and then a premium, the term premium combined with the dividends usually will go to buy down the term essentially, and then replace it with paid up additions, essentially converting it to whole life. And the reason for the term component is really to add flexibility and to add additional death benefit, and also create this ability to add more paid up additions to the policy. And it's what really causes the flexibility in the premium payments, and that's what allows you to pay a minimum premium, and then have like this option to pay additional and kind of float up and down. And some companies build it in where the policyholder can change their premium every month, every year, whenever they want. They just ad hoc send premium to the insurance company, and then it doesn't matter. There are other companies that only allow you to make changes once per year, and that makes it a little more rigid, but you still have the flexibility in terms of how much you pay. It can be reset every year. I prefer to work with companies where you can change it kind of wherever you want. You can change it mid-year if you want, with no real restrictions other than underwriting limits. So even policies where there is no term blending, there is still a substantial paid up additions component that's added to the policy, and it's the PUAs, or the paid up additions, that give the policy some additional flexibility. So PUAs, or paid up additions, are single premium whole life that's stacked on top of the base whole life policy. And since it's a single premium, there's no ongoing premium commitment for that paid up additions. As the name suggests, it's paid up. Hence the flexible nature of the PUA rider. So again, because it's just a single premium addition, you don't have to keep paying for it. You make each year you can decide, like, I want to add X amount of additional paid up life insurance to my existing policy. And it's just a single premium. And every year you can keep making that single premium. It kind of feels like an ongoing premium if you just schedule it, but it's really just a single premium that you can just keep adding every month, every year, and there's no additional commitment beyond that for that block of whole life that you just bought. So paid up additions can be increased all the way up to the maximum annual limit set by the insurance company, or they can be reduced to zero in any given year. Some companies have a restriction on that, so like some don't. And some have like restriction, but it's pretty flexible. So some companies like Penn Mutual have extremely generous provisions. Guardian is another one, Guardian Life Insurance Company of America. At the time of this recording, both of those companies have extremely generous paid up additions riders and the payment flexibility. Guardian's actually a little bit more flexible than Penn Mutual, but they're both very, very flexible in their PUAs. They allow you to skip PUA rider payments. And in the case of Penn Mutual, you can actually skip it up to, I think, 4 years or 5 years, as long as you make the minimum PUA payment somewhere within that a 5-year window. The minimum is specified in Penn's policy contracts. It's typically the way it's worded is that you have to pay at least 50% of the maximum annual payment limit over a 5-year window, over a 5-year block. With Guardian, they make it really simple. Give us $250 per year into the paid up additions rider, and you can keep your rider. In both cases, if you don't make at least the minimum, then the company will assume that you don't want the rider, and it'll drop off the policy. So the base premium is the inflexible part of the deal. That premium must always be paid, as I've said before, until your age 100. In some cases, it can be modified if it's a 10 or 20 pay or whatever. But basically, the premium has to be paid to age 100 or 98 or 99. But it can be paid with accumulated cash value from the PUAs, from the accumulated paid up additions inside the policy, or from current dividend payments, or from a combination of both. So the insurance company will handle this automatically for you. And some companies actually have it's software driven. It can be triggered in the future, with an automated, what they call premium offset program. And it's software driven. It just automatically happens at a set date in the future. But the insurance company handles this for you if you choose that option. You can choose that option during the application process, what they call at issue. And it can be turned on at any time after that. You could modify it after the fact, as long as there's sufficient accumulated cash values or dividends to pay that base premium. Some policies have an automatic premium offset option that's elected when the policy is issued. This will happen. Your agent would design this into the policy for you, and that would be something that the company sets up, and you have to confirm that you want that, and so on and so forth. And then every policy, at least every policy that I design, but if an insurance agent is working with kind of the major carriers, those policies can be converted to a permanent paid up policies somewhere between 5 and 7 years. Usually you have to wait a number of years, and it's it could be like 7 years, 8 years or whatnot after the policy is first issued, with no further premiums due. And that's the reduced paid up option. So as I mentioned before, the reduced paid up option, the insurer eliminates the requirement for base policy premium. It eliminates any supplemental premiums that you have, typically including the paid up additions. You're not going to be able to pay additional premiums like that. It terminates the PUA rider, reduces the death benefit, and so on and so forth. But the cash value keeps growing, and dividends from that base policy keep growing. And so any accumulated paid up additions you have, the base policy and so on. So your policy keeps earning dividends. The cash value keeps growing. It's just that you can't put anything more in. And that's it. Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniix.com, and sign up for my daily email list.